I want to appreciate you, Mr. Tijani. Thank you so much for being with us and for taking this program with us. Everybody, I want to welcome you on board. My name is MJ Young, CEO of GTI. And I want to tell you that you are in the right place, you're in the right hand at the right time. First of all, I want to say that this journey is going to be rough. So tighten up your seat belt and take your destiny serious. For some of us, even though we are still, still have time, we started this journey as far back as 2008, and up till now, we are still in the game. So we are making progress. But the good thing is you are having us here to pass experience and knowledge to shorten your and other out ready. And before the weekend, we will announce evening. I believe every one of us has followed the 1, the 2, and this is the 3. And it is important we begin to opportunities and to to other things to leverage on. Let me tell you something. One of the most important wonders of the earth or the world is the power of leverage. It's called leverage. For everything you don't have or you don't have enough, leverage can help you to, make shortcoming. Leverage can help you, not for you, to get you to what is enough. And that is the reason why, as we are doing this training, we want to introduce you to some things. For example, the copy trading system in Infinos. I want you to take it very, and I'm going to be showing you briefly. Then as time goes on, I will talk about it. Then number 2, I also want you, after this meeting, we are going to be posting the link on the Telegram group and the WhatsApp group for you to open an Infinos account with me. This seminar may look free, but it's not free because the broker is also paying for this seminar. What I'm saying is, for Mr. T to be here, it is also part of, it is also part of the sponsorship of the broker, not just because he just only want to be here. So it is important we take the broker serious, Infinos, because our partnership in this sacrifice, and the broker is also doing it, the same thing as us. So I want to introduce you quickly in the next 5 minutes to how do you leverage on making money, because there are other ways you can, while you are learning, you can make money with us. Apart from that, you should be able to also trade with our broker. Number 3, you should also know at this point, that although the beginner's class is free, the intermediate is also free, but you must have to fund amount of money, just little amount, with our broker, which is Infinos. So you are not giving us money. It is still, while you are still doing training, you are definitely going to, you're still going to be making money. Let me tell you something. We're not going to be wasting our time. We want serious people. For example, my mentorship is nothing less than 5,000 US. I wonder why I'm going to be organizing this just for free. And yes, it's still for free, but you need to take action. If not, you sit down, you're going to be having what we call a cycle of our people go to school, memorize, come back, sit back for exam, and then graduate, and they don't know what to do with their life because practicals were not involved. The Forex market is very real, so you must be committed. In as much as I'm bringing the best of the best. Mr. Tijani will be there. Mr. Narish India will be around. Mr. Steve Eva will be around. You too need to play your part. I don't want, with all this, you are going to intermediate and you are still doing demo. At the beginner's class, demo is permitted. At the intermediate, we want to see some form of from you also, which brings me to sharing my screen quickly. Mr. Tijani, please, can you allow me to share my screen quickly? to share my screen quickly. So while Mr. Tijani do that, please, like I said, this information is very, very important. You will not be partaking in the intermediate class some level of commitment from you. You will not take note of that so that you don't say they did not tell you. Okay, I'm sharing my screen right now. If you look at the screen, you will see MJ, the IS social, you will see 76 followers, 36 copiers, and so what do you need to do for you to start copying my little trade from your ends without you trading? It is simple. You just only need to take 2 steps. After this meeting, we are going to be posting my link to the broker. Don't go straight to open an account. Please, open an account with a broker you can trust and open accounts, with Infinos. We are recommending Infinos, and they make it easy for all of us. So number one, you use your account. Once you open your account with the link, I'm going to give you also a number on the group, the SAM, for verification, to follow up for your verification. That's number one. Number two, you can fund $50, $100 and above, that minimum of 50. Fund from $100 and above. And next, you are going to copy me on the IS social. Don't worry, they will help you. Sam will be on ground to help you link your account. Once you do that, what will happen? Any trade I take on my account is going to be taken on your account too. There are some people who are listening to me, about 36 of them last week, because I took trade on my account. So it will reflect on your account. That is how it is. You don't need to be online. You just need to watch and, watch the trade going on and profit coming in. Yes, it's true. Disclaimer, Forex is a risk. But some of us have also been able to pay the price to minimize these risks, to help you make more money. So what are we saying? We're saying that take notes. You can start copying and making money. And number two is also give you access to the intermediate class. Nobody will wait for you. Just in case you're also waiting that we're going to post it on our YouTube, of course, we're not going to do that. So that means you need to participate very well in that class. If you needed to pay for this course, trust me, only the day 1 and day 2 of this course, your money would have gone. And I'm telling you, if you ask anybody online here that have paid for Forex class before, they will tell you that it is expensive, and they even get junks. Some of them did not even get what they really wanted. But then we are here, we are bringing this to you. So ladies and gentlemen, after this meeting, you can ask your question on the Telegram, and you can also introduce your friends. See, for the people that are taking us serious and copying us, copying me, and they are going to be funding, within the next 1 week, 2 weeks, and the rest. See, I'm going to be having special sections with them. It's very special. See, you can't truly pay me for what I do. And the truth is, I am going off the Forex line soon. And this is our way of saying thank you. Thank you to many of you. So if you want to enroll, the first thing you need to do is to make sure you are copying us before the door gets closed. That is the first thing. I will never, excuse me, I will never take you serious, no matter how much you cry or beg, until you are committed. Commitment is a sign, it's a proof of seriousness. No man is deemed to be serious until a level of commitment comes from that man. Commitment is a seed for seriousness. How do you show your commitment? You show your commitment first, taking the first step by opening through our link. Secondly, by verifying your account, and then copying us. And trust me, in between this meeting, you begin to have my attention fully. I will not give you attention if you have not taken that step. Ladies and gentlemen, thank you so much, and God bless you. I'm going to leave Mr. TJ because he's taking us on this class to take up the class for today. And any other question you can ask. Mr. Tijani, thank you so much.
All right, thank you very much, Mr. MJ Young. Please, can you make me the host back so that I can have my screen share enabled? Make me the host under the participants, under the this. Hello.
Tijani, just a second.
Okay. All right.
You are not the host.
All right, sir. So sorry. You can stop sharing screen, sir. All right. So I'm going to be sharing my screen and then we can start today's session briefly. But before I start today's session, I want to take us back to our table of contents, what we are going to go through. So in our first day of session, first session, we had the definition of terms and a basic introduction to Forex. The last class, which was day first today, we had how to open trade using the MT4, MT5, and the 100 antique. We had whatever. If anybody has any challenge as regards what we did, please watch the video, ask questions in the group, and then we can have a recap on this briefly. Okay, we usually talk about how to trade the market, how to set our trading terminal, and how to set our news terminal effectively. I talked about sentimental trading, how to read the mood of the market, tracking market that has done 90% and above, and reversing trade on that kind of market. So helping us to join the market at the very peak. That's sentimental trading. Then the technical is what we are still discussing. Under the technical, we talked about the candlestick chart, the type of chart in line with candlestick, bar charts, and line charts. We talked about not going to be paying attention to bar charts, but devote our attention to line chart and candlestick and when to switch between the two of them. So please, if you have a way, if you meet any of those class, please watch the video on the YouTube channel. And then we talked about the formation sentiment, and today we're going to talk about blending of candlestick. That's where we're going to start. So as a quick one, I just want to say thank you if you have stayed tuned with us from the beginning up to this very moment. So now, let me take you to my notes briefly, where we're going to be talking about the blending of candlestick as far as today is concerned. So we go to slideshow from current page, okay? All right. So as a quick one, briefly, we talked about the blending of candlestick, and that's where we'll start today. Now, if you go to the Forex chart, looking at a weekly, or let me say 1 month candlestick, 1 month candlestick has 30 candlestick on the daily time frame. Then going further down, one daily candlestick has 24 candlestick on the 1 hour time frame. So the big candlestick that you see and you hopefully believe in is a combination of smaller candlestick on the lower time frame. So peradventure you were given multiple of candlestick and you are asked the decision on what that kind of structure is presenting in the market. This is where your knowledge of blending of candlestick comes in. So now, for instance, like I said, I'm not going to talk about individual candlestick and their name. It is of no importance to me. Let's say the candlestick lines up like this, lines up like this, lines up like this, lines up like this, lines up like this. So these are candlestick all the way. Then lines up like this. Then we now have one that lines up like this. Somebody now said, what is the structural importance of this candlestick? And you want to ask. Now, I will say equals to what? So what you do is, if you want to blend all this candlestick without possibly missing out anything and then coming up with a decision on the kind of bias or sentiment of this candlestick, what you do is this: you identify the very highest of the candlestick, point number one, identify the very lowest of the candlestick, right? Then identify the open of the first candlestick. Let's say this candlestick opens at this point, and identify the close of the last candlestick. Let's say this candlestick close at this point, right? So we are looking at close here and we are looking at open. Let's say the market opens at this point, right? So invariably, what we have is this. We have our open here and then we had our close at this point, right? So we had a wick to the upside, then we have a low to the downside. So this candlestick should look like this, obviously, like this. So invariably, it means that all those candlesticks from the very start to the very last all gave us just one candlestick that looked like this, in such a way that this candlestick once went up but forcefully reject and close a little bit down at this point, right? So this is a candlestick that closed very low. So your job is, if you want to identify the sentiment in this candlestick, of course, this is the open and then this is the close. If you look at this candlestick obviously has a bullish sentiment because the close is above the open. But if you look at it, the bias is bearish, right? Because something caused this market to forcefully reject from the top, creating a trap at the very high point and then closing at this very low point, therefore giving us a bearish bias. This is the kind of candle you want to sell immediately. Now let's take a look at this blending. So when you look at candlestick, you can combine them together by looking at the open of the very first one, the last low, the last high, and then the last close. Then you can form the candlestick and say this candlestick is bullish. Now, if you take a look at this one, the same thing happened in this candlestick. Now, let's go to the chart and then you can see what I'm trying to say visually. So if you look at the charts and then you come to this realization and say, okay, let me look at the chart, obviously. Then you come to the daily time frame. No, let's say you come to the 30-minute time frame. So in the 30-minute time frame, what you have here are combinations of candlestick, right? Candlestick combined together, right? From this very point to this last low. So what you do if you want to merge this candlestick together is for you to identify the very high at this point, right? This is the high, right? And then this is the low. So if that is the high and this is the low, what then happen? This is the open of the candlestick, right? This is the open, isn't it? So you bring the open up to this level, and then this absolutely going to be the close. So what happened is that the open is here, right? And then the high is here. So this is the candlestick that has a wick, and then come down and ask this wick. So invariably, I can say my view is I have this kind of candlestick that looks like a doji, right? So I can just delete anything that I don't need. So this is the candlestick. I've just combined all the candlestick. What happened in between does not concern you. You only need the open, the close, the high, and the low, irrespective of the candlestick that makes the number of candlesticks that makes that so you can come up with decision that this candlestick should look like this on the daily time frame. Now let's go to the daily time frame and see what that candlestick actually look like. Now if you come to the daily time frame, in view of what I have there, so technically this is what you're going to be having. You can see that we just blended all those candlesticks together, and now you can see that this candlestick obviously look like this that we have on this board, right? So without you even whatever, so the daily candlestick has combined all the 48 candlesticks that makes the 30-minute time frame, all the 24 candles that makes the 1 hour time frame. That is what we call blending. So when it comes to trading the London session, you understand, this blending will become very, very important to you as you progress in this course of learning. You're going to be able to know the Asian bias and then using the Asian bias to judge what should be happening in the London market. And this will become very, very obvious as soon as we get there. Now, let me just take you briefly into a short piece. The Asian market closed 8 a.m. GMT +1. So from this Asian market close line to the open of the day, if you merge together, you can see the bias and the sentiment in this market. Like this is the high and this is the low, then this is the close, right? If this is the close, it means that this market close above whatever, then you can be envisaging some moves. When we come to the strategy aspect, looking at the blending, you will understand what I'm trying to print here. But for now, let's just understand that if you want to blend this candlestick from year to year, the demarcation line you have on this chart is a demarcation line that indicates each day, the open of each day. So this is what happened yesterday. Like this is what happened yesterday. This is currently what is happening in today's market. This is what happened yesterday, and this is what happened day before yesterday. But each of these multiple candlestick can be combined to form one candlestick on a daily time frame. And then you do not need to do this manually, but you need to understand how this candlestick formation is being done on a normal ground. Okay, so that is why the need for understanding the blending of a candlestick is very important. So when you want to take a buy order, you want to see the combination of the last two candlestick or last three candlestick giving you a sign of bullishness in bias, then you want to be looking at a buy. Now, also, if you are going to be taking a sell like this, you want to see a candlestick combined together and giving you a bearish bias, then you want to take a sell. Okay, now these are going to be a little bit technical, but with practical session, you're going to understand this blending. So as a part of assignment that you need to lay your hands on, what you need to open chart, pick 2 or 3 candlesticks that stand side by side, try to blend them visually and come up with the decision that the result of the blended candle will give to you. Then you can look at how the market reacts in retrospect to that. If candlesticks are blended together and is giving you bullish bias, you should prepare to buy. If multiple candlesticks are blended together and is giving you bearish bias, then it is expected that you want to be selling. How do you know bias? When you get the solution, the merge, whatever, put the middle line. If the market close above the middle line, prepare to buy because this is bullish bias. If the candle close below this level, prepare to sell because this is a bearish bias, and that settles that point. Now, aside blending, which is going to be a digression today, the next line of action we're going to be talking is support and resistance, trend line and its application, then oscillator. Why we decide to use or pick RSI among all the oscillators that exist in the Forex industry. First, I will start with support and resistance. Now, in retrospect, by way of practice, what is a support? A support, as far as I'm concerned, can be defined as if a support can be called a floor, right? A floor. Floor. Bouncy, please. Okay, just these are the layman's way of putting it so that we all can get ourselves float up. So let's say I have a level at this point. This is a level. So I'm going to be like, let's say this is a ground level that and the diamond floor at this point. Now, this level, I now had to throw a ball. The ball was dropped. What do you expect? The ball will bounce off. Now, if this ball bounce off this level, I will say this level that the balls bounce off is called a support. Okay, support, because it supported the market from not going deeper into the level. Now, this support causes the market to change direction into the upside, right? That is a support. Now, by way of definition, support can be defined as the level in the market, a structure in the market that causes the market to reverse back to the upside or stop the market from going down further or stop a movement from continuing going down, rather causing it to go up. That is a support. Okay, now, just as we have support, resistance is the opposite. Let's say you have a structure here and something was thrown up and it got to this level and it does come down. What happened is that this market has just created a resistance here. So invariably, if support equals to a floor and equals to bouncing place, then support resistance will be what? Resistance will be a roof or a rejecting place. So let me say roof or rejection place. Okay, I think it is fair to put it that way. So this level is called resistance. So I will label it resistance. Now, when you're looking at resistance in a layman's term, then you see that it is a level in the market that stops the market from continuing going up, now thereby causing a drop in the market. That is a resistance. Now, if you look at the market, you will definitely see a whole lot of resistance. So when I want to talk about support and resistance, I would like to use the normal market example in the market. Now, let's say this is it. Like I told you, if you want to study support and resistance structure, you will need to change your chart from candlestick to line graph. This is it. So I'll change my chart to line graph in this case. Now, when you do that, then this is what you have. Market had a bounce at this point. When you are looking at support and resistance, you start by looking at the current market price, which is going to be here. So the the analysis you want to do must reflect around the current market price. It is going to be of no point trying to identify the support and resistance 10 years ago when you are looking at market currently. So you look at the structure around the current market price that has the tendency to cause the market a reaction. Now, this is it. Before we go on with this support and resistance, when a market is going up like this, once it gets to a resistance point, it does what? It reverse direction and go down. When the market is coming down, when they get to a support zone, it does what? Let's say the market has once gone up from here. So by the time it's coming back again, what the market do? The market will just hit this support level and then bounce because we have existing structure of support at this level. Let's say I have existing resistance here. So by the time the market will come back again, what the market will do is this level is a resistance, then the market will then reverse and come down. So previous resistance in the market will often act to show its capacity as a resistance in the future price. So when the market has a support here, okay, it is expected that when the market is coming back, it should still keep respecting the support. But more than often, when the market gets to the support or the resistance level, three things can happen. These three things are: one, market can either break the support, break it, pause around it, or reverse. Market can reverse. So when the market gets to a key level, this is what happens. It's either the market does what? Go and reverse around it, one, or the market break it, two, or the market start consolidating without taking a decision on where to go. Those are the three things that can happen. This is one, this is two, and then this is condition three that can happen. So you don't have to assume that market will definitely respect a particular support or resistance. You just need to watch the price action around this support and resistance. So when it comes to understanding support and resistance, we want to pay attention to the key structures, key ones, not just everything that moves or that causes move in the market. Like for example, if you take a look at this market at this point, this is a support, right? These are supports, Abby. These are supports. These are support. We have so many support in this market, right? Because they cause the market to move around, isn't it? But you are not going to be paying attention to all the support, because otherwise, if you do, you're going to get confused at the time, and you don't want to entertain confusion when it comes to trading. So what do you do? What do you do is that there is another level of support and resistance that you need to learn. We now divided support and resistance into what we call a minor, and then we asked what we call a major. Now, when it comes to support, we have both minor and major, and then we have, for resistance, we have both minor and major. What is the difference between a minor resistance in this market? A minor resistance simply means that a level that was tested once and then causing the market to react level. Now, let's say the market happens to be coming up like this, right? The market now came to this level and then reverse like this. So when the market reverse, at this point, this is a resistance. Because this level is tested just once at this point, causing this reversal, we say this is a minor resistance. When a level is tested once, proud to reversal, we call it minor. Okay, we call it minor. So let's put minor here. Now, if a level is tested, let's say this is a support also, and now the market come down and then bounce off it. Now, this level is equally a support because it caused the market to reverse up by way of elevation. But this level of this reaction is just once, isn't it? So if it is just once, then we say this is a minor support, right? Now, there's another argument that says that the higher the number of times that the market hit a level and sustain, then the stronger that level will become, isn't it? So anytime if this market comes back and hit this level and then sustain, then it means that this level is getting stronger as a resistance, because as the market hits a level, the same number of times that it hits the level, there are sellers at this very point. So sellers are increasing. When sellers are increasing, that means their capacity as a resistance is increasing, right? So this converts this level to a major resistance. Now, what is the definition between a minor resistance and a major resistance? A minor resistance is a level in the market that causes the market to react from going up into downside, or cause the market to turn from going up to the downside at the first time it's tested, right? That is a resistance. But when it comes to, that's the minor resistance. A major resistance, therefore, simply means the level that reacts, the level that causes the market to react repeatedly in the market. Now, this is the market. If a level is tested more than once and causes the market to go down, stopping it from continuing to go up, they call it major resistance. If the market caused a market to stop going to down more than once, then we call it major support, right? Now, in the market, when you want to create your support and resistance structure, you want to look for levels that are majors. Levels that are what? Major. Levels that are what? Major. You relegate all the minor structure. Otherwise, if you want to pay attention to minor structure, you are going to be having a whole lot of confusion. Then your chart will be filled up with so many lines. So when you want to create this major structure, your job is to begin with understanding the major levels, not the minor levels. So you look for structures where the market reacted more than once and create a form of resistance. So you expect that the market, upon coming back, to do the same thing that it did in the history, right? That settles that. So upon this, there's also equally another structure you want to see in the market, and that is when it comes to demand and supply. Now, when a market is going up like this, right? This is how the market goes up. It doesn't move in a straight line. It goes up like this. Then the market comes in the downside also like this, downside. While it is going up, we say the market is flowing to the upside. While the market is flowing to the upside, we keep having this purview of market going upside. So now this is it. At this very point, we have resistance because the market causes the market to reverse here. Then these are resistance, right? These are resistance. We have multiple resistance in the market going up, and then multiple support in the market going down. How? This is it. These are support, right? Support. Market, it causes the market to go up, right? At this point, these are support. So X stands for support, arrow stands for what? Resistance. These are support, right? These are support. You want to be looking at it that way. So in a downtrend, the market will keep making series of resistance, but overall, the market will be flowing to the uptrend. In a downtrend, the market will be having series of support, and the market will be flowing to the downside that way. But whichever the case, it's just a reverse of each other. The same definition stands. Now, at this very point where the market causes get to this level and then did a overrun to the upside like this level is no longer a support. Why the market is reversing, by the time this high is still not violated, we say this market is a support. But immediately the market is violated to the upside, it's not becoming a support, rather it becomes a demand. Okay, now What is the difference between a support and a demand? A support causes a market to reverse from its original direction. A major support reacts to the same level more than once while creating the reversal. However, a demand must ensure that a new structure high is formed. That means the structure at this point is violated. If a structure at this point is violated, before it can happen, there must be enough energy, enough force that is causing that market to go that high. You and I both know that one thing that uprules the forex market is the principle of demand and supply from economics point of view. When the demand for a product is increasing or is high, what happens? The price starts going up. For example, now food, now there is no supply for goods from the producers. Food is very scarce in Nigeria, and you can see that the price is getting higher for almost all food items in the market. But if it happens that somebody just opened border and food started coming in full force, what happened to the price? The price will now eventually drop. Now, if a supply for a particular commodity reduces, the market, that product will become scarce, then the price will skyrocket. That is it. So if a supply is reducing, it means that demand is increasing. If a demand is increasing, it means that supply is possibly not there. That's why people are rushing for it, isn't it? That's it. So when the demand for any product is increasing, the price starts going up to match up with the increasing demand. It's a simple law of economics that says when a price for a product is increasing, then when the demand for a product is increasing, the price will equally follow suit. But if the supply for a product increases too much, what happens? People call it pure water. That is everywhere you go, you see it. So people stop valuing it, isn't it? And then the price starts dropping. Now, for a price to drop, there must be increased supply. For a price to rise, there must be increased demand. So this level where the market made this low and then give us a new high resistance high to this level is called a demand. Now, the structure you want to see when you're looking at your market technically is major support, and resistance. Then aside the major support and resistance, we equally want to see supply and demand. I've explained a demand. Let me explain supply and then demand. What is a demand? A demand is the level in the market where the market made aggressive buy, therefore giving us a new higher structure. Now, supply invariably will be seen as the level in the market where market did aggressive sell, therefore giving us a new lower structure. I hope that is clear. Let's put that by definition. Supply, let me say demand. Demand is aggressive by giving rise to a new higher structure. Sorry for structure. I hope that is clear. Whereas supply is an aggressive sell in the market, thereby giving us what we will say new lower structure. I hope this is clear. Now, if this is clear, then we can proceed. Now, what I mean by demand simply means that you want to buy the market, Abi, with a view of giving us a new high, isn't it? So a market is like this. You bought at this point. This is the last high that was formed. The market now went up. Therefore, a new high has been formed at this point. This is going to be a demand. For a supply, the market was coming up, then the market changed direction. Why is changing direction? It is a resistance to start up with, then it ended up becoming a supply in this case. This is called a supply. I hope that is clear. When the market creates a new, this is a new structure. This is a old one. This is a new lower structure, and that makes this level to become a supply. Now, so let's do what we call mapping of our chart. Mapping of our chart is when you open a blank chart, irrespective of the chart you want to see, you want to identify the key levels in the market. Now, the key levels in this case are the support and the resistance in the market. I mean, the major support and major resistance in the market, then the demand and the supply level, right? So this market is going up, and if it is going up, let's put structural level. I'll pick my horizontal line from the top of my chart. I will start by looking at this level. Why? Because there was a structural, let me just say, I will say I have this. So this is what I have. I just connected it together to make it look good. Then I have this. Then I have this. So this is what I have here. So I will say I have this. Now, this is everything I have on this chart. Let's put lines to it so that we can possibly see our key level. Now, I will pick the first line. I will first go to this level. Why am I going to this level? Because I can obviously see that the market has a test level here, test here, and then test here, because that is a 3-level test. So this becomes a major resistance first, but we have a new low below this level. This makes it a supply. So this is our supply zone, major level to respect in this market, supply. Now that makes us to fix that line at 39.06. Now mind you, when the market did this level in the money and gave us this structural violation at this point, by the time the market came back to this level into this market, what happened? The market reacts to this level because we have a supply here already, and then the market now dropped low. Now you will need to do some practical session for you to understand this technically. Now in this case, I will say also that the market has another level at this point. Then I will say the market has another level at this point, because if you take a look at this market, it has a level here, a test here, and a test point here. So these are 3 levels within the reference page. So this is the next level. Now invariably, this is just a support, right? This is just a support because it caused the market to turn back, but no new structure was formed, no new high. So this is just ordinary support. So I'm not going to respect this level at all. Rather, this market possibly, as it gets to this level, something should tell you that this market has a way it have to come to this level. When you put your key levels on the chart, it has a way of attracting the market. Now let's choose another chart. I will want you to suggest a particular currency pair you want us to use as an example, so that it does not become like we created an example based on what we are prepared for. Okay, so I need somebody to suggest for me which chart we should use as a case study in this meeting. First, suggest for me, give me a currency pair, anything. All right, I have NZJPY. So let's look at NZJPY. So show all. So I'll look at NZJPY, right? So this is NZJPY. First and foremost, you will let it load. Then the next thing is you want to, of course, when you load your chart, it will be a candlestick. But if you want to create this support and resistance structure, you turn it to line chart so that you can see the exact turns in the market. Now, the first thing you want to see is where is the current market price, right? Is currently here. So you operate within the current market price to pick the key levels. Now you come to this level and say, okay, this market has a structure here because there are 2-time tests. Abby, it's obvious. You just look for areas on the chart that are obvious. So this market had a high here, then we have a higher high here. So this market has what we call a demand at this point, right? You can see that we have a demand there. Then this market has come to give us this level has been violated, meaning that this level is a supply. You identify that level. And then the next thing is if there's any 2-layer structure you want to see. Okay, so let's say for now, I cannot see it. You know, I've not gone too far. I'm just operating within the template I have here, let me just say I want to look at this point, then I will bring it to line chart. If you take a look at this point, you see that the market reacted over a period of time, not just a sharp move like what happened here or what happened here. This market is just a support at this point because it has not given us a new structural high, so we're not going to respect it. So your job is to respect levels that are tested more than once or the supply and demand. So in this case, I've created my supply, my key levels on this chart as far as this chart is concerned, then I'll bring it to line chart. So when I bring it to line chart, I possibly can say, okay, I will fine tune it. I will bring 2 line here. Then I will also respect this level and bring this one here so that they can capture the exact structure. So when you see people draw beautiful charts, this is what they do to create their support and resistance line. It shouldn't just be like it has to be a particular figure, right? So I will now remove this. Then you have created this structure. The next thing is that you have a key level at this point, right? So I will adjust it to fine tune the exact key level because this market has a test here and also a test here, therefore giving us this level as a 2-time test. This is what we have here. Market come like this, drop, come like this, and then drop. If you go to a lower time frame, that's what you will see. All right. So now that you have seen that, you have put up the structure in this market, your next assignment is to expect a market rally to this structure, then you sell this market into the new structural low at this point. This is how to create your trading plan, having understood the concept of supply, demand, and support and resistance in view. You will track the major support and major resistance around the current market price. You will track the demand and the supply around the current market price. Turn your chart to line chart, then put line at levels of majors in the market and supply level in the market and demand level in the market, then bring it back to candlestick, then start trading your credit, create your trading plan accordingly. So you expect the market to come to the next structure in such a way that it will take a whole lot of kind of move like this. Then you sell at this point for a drop in this market. Why are you going to sell at this point? Because you already have a level of support and resistance, or let me say point of interest or key zone around this level, because this level is very strong. There are 2 levels of support, key zones that are close. Once you put this line on the chart, you stop seeing them as support and resistance. You start calling them key zones. Okay, you start calling what? Key zones. So you start by looking at what a minor support is, what a minor resistance is, what then differentiates between minor support and resistance and a major support and resistance. Once you understand that, you will now delete the premises of minor resistance and minor support. Then you now come to the next level of understanding what is a demand and what is a supply. Once you pinpoint these 3 parameters and you know them practically, then you turn your chart to line graph and identify them on the chart. So this is NZD JPY. You do this without applying any special indicator, and then you can be perfectly correct with your analysis, and then you can create your trade plan. So at this point, I want you to keep this class, note this class, make it private, and then when I come to putting it all together, we will revisit this message again, and then you will now see whether trading is hard or whether trading is tough. But if you do not have a live account with us already, then you're going to be missing out in subsequent classes, because in subsequent classes, in intermediate class, it's going to be more or less like earning and learning. Now, this is it. MJ started the introduction of this class on the premises that we want you to combine both. Looking at the situation in the country now, most of us possibly the economy is biting hard, and we want to see how we can grow. Hence, while this course is ongoing and you are learning, you can put your money into investment cycle where you'll be copying the trade of expert on IS Social. MJ Young is there to provide you trade from his trade here. You can get copy. So while you are learning, you are equally earning. So by the time you perfect your understanding, you understand you are not on pressure of when will I start earning. You already started earning while you are learning. And by the time you get to the end of this class and you already have a mastery and you find the kind of trader you want to be, then from then you can start doing the trading yourself. Then you can come and become your own fund manager, your own asset manager, or whichever you want to do. Just decide it by yourself. This is a noble profession, and yours is to make a decision as regards how you want to play with it. Now, let me look at the chat box. Somebody equally has a question the other time. He said I should use GJ in this, whatever. Now, in this GJ, now this is GJ that I want to look at. So let's take a look at GJ. Mind you, this chart does not have any indicator. So let's go to Control M and then we go to GJ. Just press G, GJ, right? I think, okay, this is GJ. Now, I love, like, when we want to talk about this type of thing, people give me ideology on what they want. So if you take a look at this, I'll change my chart to line graph. Then I will know that I know that this is a high and this is a higher high, right? If that is the case, then this becomes a demand for me, right? So if this is a demand for me, now I'm going to be continued that way technically. So this level, as far as I'm concerned, has a structure move in such a way that the market has, let's say, let's look at it critically. Here we have structural move, here we have test here, and then so I will respect that level as my 2-point tested before violation, so as a major resistance. This is a demand in the market. Then the next thing I want to see, if this market violates this level, it will not have any respect for any level until it gets to something like this, because we have a demand at this point. This market causes this move from here. So I'll just identify something like this. So this is what we have. Now, in this case, I'm going to be looking at we have a violation of this low, right? So if this low level is violated, then this becomes a supply, right? So if this is a supply, that place is equally very important as far as trading is concerned. So I'll remove this. I will now put a line at the very last high here, and that is a supply. So I have a head of supply here. So I expect something like this, a movement like this, then a drop like this into this level. However, if this level becomes violated, what will happen is that we will now just have a retest, and then we will have this structure, and that settles a whole lot of things. So you should be, once you can map your chart, identify the key levels. Like I said, once you put this line on your chart, you stop calling them support and resistance, you start calling them key level. Why? Because if you call them support and resistance line, what about demand and supply zone that are already inserted into this? So you're going to be inserting some trading principle, and so you just call all of them one single name, key name. So the issue of support resistance does not come in. So once you have created this chart like this, you equally identify the very last low in this market. These are the key levels in this market. Then I will do what? I will bring it into line chart. So when I bring it into candlestick chart, I will now fine tune it very, very well. So when I do, you can see that this market has a high here, test it here, and then this level becomes a major support, resistance before the violation, and then come up. So in this case, I'm going to be like, put this line here to make it colored, okay? And then this also, I will bring it here to equally make it whatever. Some people, when you look at their chart, they will put some color here. It will not look like fine art. So I can as well do the same. So they will tell you key zones. They will tell you key zones. You don't need to do exactly the way I do it. Just understand how to do it. Then you can say, okay, these are the key zones in the market. So now what we're going to be expecting is that tomorrow we're going to be seeing market movement into the key levels in the market. You do not need any special indicator to do this. You just do it manually, like converting your chart and looking at the structures close to the current market price. So this is a demand. Market should come back into this major resistance zone at this point, form a barrier, and then become whatever at this point. And that is the trade plan for tomorrow. We just create a trade plan for tomorrow on GG, and you can keep the picture of this. And then if the market does not do it, then we can revisit in the next class and say this course is not going to work. Then we can possibly call it a quit. Okay, but if it does happen, then it should solidify our interest in learning further, right? So let's see how it goes. Now, in view of this, I think we are done with support, resistance, and the mapping. So let's take a look at our next topic in this forever. Trend line. and its application. What are trend lines? When once you are done with mapping out your chart like this, you want to know the market. Of course, the trend line is a structural technical tools that helps you to guide the market, as in guide you in the market flow, telling you that you are still in a bullish trend. So how do you do trend line? Now, when you want to do trend line, let me put drinks something like this here. So let's say the market has this kind of structure to the up move, up, up. So the market will keep doing a whole lot of things. Let's say like this. If you give 10 traders this chart that I just draw and say put a trend line on this chart, a lot of people, you will see a lot of things. Technically, the market only respects the last two lows in the market, the last two demand in the uptrend market, and the last two supply in the downtrend market. That is how the market often remember. So what is a trend line? A trend line is a line connecting the last two significant structure in the market, therefore guiding the flow of the current flow of the market. So if you were to put a trend line on this chart, somebody will tell you connect this one and this one together, and then this one will become an overshoot. Somebody will say no, connect this one. Somebody will say no, connect this one. Then you start getting yourself worried. This is how you definitely has a whole lot of different view. But the right way to draw a trend line has to do with understanding the current flow of the market. And the current flow of the market has a respect for the last two significant structures in that market. So in this case, the last two significant structures in this market is the last demand in a bullish trend and the last two supply in a bearish trend. Like I said, when the market is dropping, you look at supply, because at this point, the market dropped aggressively into the new low. And at this point, the market drops aggressively and create a new low. So as long as a new structural low is created, then you have a supply at this point. So the last two is what you always track, irrespective of what the chart is doing. Once you open your chart, just track the very last two significant structure. If it is uptrend, you can say uptrend. If it is, you can look for supply in a demand. I mean, in supply in a bearish market and a demand in a bullish market. So if I want to draw this trend line, I just have to connect this low and this level together. That's all. I don't have business looking at what happened here. Everything after that two significant structure becomes a bullshit. You do not need it. Many people do not know this trick and possibly just start giving themselves headache and worry, and they will not be able to put a trend line in the market. So trend line is more or less like a trend guider, telling you this is the extent to which the market is. So what do you put the trend line on the chart to do? The market is expected to keep maintaining move above its trend line. Anytime the market comes to the trend line, it bounces off it. So if the market keeps going up, at a time, the market will violate this trend line. And once the market violates the trend line and creates a shift, like we said, the next thing is that the market will just make a pullback, and then the market will start a new directional flow. So it is expected that when the market, if a market must contain or maintain its current flow, its current trend, its current direction, then it needs to respect its trend line. Now let's take a look at charts, and then we can see how this works out in the real life. Now, this is what I have in this case. So I'm going to say from year to year, I have this market making this low, this high, making this, right? This is what I have. So invariably, I will respect this level as my two significant structure, right? At this point. And I will respect this one as my two significant structure. So if I want to draw a trend line, I will just connect what I have here from year and year. And that's it. That is my trend line. I just put trend line to this chart without sweating, right? So irrespective of the chart, you can do this. And this is how to look at the chart holistically without applying any special indicator, but on applying understanding and principle in the market. Okay, so it variably means that at this point, when the market violates the trend line, look at this point, the market violates it here, right? So it is expedient that the market should come back to the retest of this trend line at where? At this point here. And therefore, it is coming down, it should go do this. And okay, because when the market violates the trend line, it means that the trend is over. Then the next line of action is to expect after the violation, a pullback. Then you expect a shift in the new directional flow that the market has created. So the very first thing you want that signals the end of a move is a violation of the trend line following the market. Nothing is complex. only if you want to apply simplicity to it, and it cannot be this simpler. This is what we call price action and understanding of trading principle in the market without applying indicator. If you are in this class, watching this class, I'm placing a premium value on this class. This is value for $1,200 in the class, but you have it free of charge this time around. I'll consider yourself very, very lucky. Now, when you look at market this way holistically, you apply this, then you take a sell decision in this market because you can see a trend line violation at this point. So you only need a pullback to the key levels. Mind you, why this market was coming down, there was what we call a consolidation at this point. So this consolidation that you saw at this point should become something like a reference point in the future where we add this key level. Of course, the key level is here, right? So you expect this market to come to this level. I can place a sell limit here and expect a market to come to this level. This method is not just applicable to the forex market, it's applicable to anything that obeys the principle of cycle analysis in the entire speculative industry. Forex inclusive, cryptocurrency inclusive, volatility index inclusive. So irrespective of the market you want to trade, you can apply the same principle, understanding structures, understanding support and resistance, understanding your key levels and how to map your chart and how to gauge trading principles in line with it and apply, creating your trading plan. Right now, I haven't done this, so let's go into another whatever. I will base it based on what you have picked. If you whatever the currency pair you pick, that is what we discussed on. So you picked AU, UJ. Okay, let's look at AU critically. So AU, as far as I'm concerned, has this structure. Let's take a look at AU, right? I think AU. Okay, this is AU. We'll open this way. Then when you open this way, see, please, if there's any reason why you must work with any complex indicator, wherever, please just take it like it is not really going to worth it. So for instance, this is AU. The first thing you want to look is the current market price. So you create your structure around this current market price. So you remove every other thing that you possibly, so this chart is as good as clean. So you start from this kind of structure. So to pinpoint the exact key levels in this market without wasting too much of time. To pinpoint the exact key levels in the market without wasting too much of time, start by putting structural whatever here. So this level and this level got tested 2 times, right? So this level, we had a new low at this point. So this level is a supply. You put a line there. Now, this level also at this point, this level has a test here, has a minimum, a maximum, a aunt here. So you put structure like this. That settles that. Then the next thing is you want to see that this level was once a demand. I mean, there's a new high and there's a new high here. So this level is a demand structure, but it has been violated. And then if you look at it, after the violation here, the market came back for a retest and then continued to drop. So this level has been used up. So I'm not going to be concerned too much. The next thing is that I want to respect this level because it forms a new high above this level. So this is equally another demand. Now, this demand has been used up. If this demand has been used up, expect market to come back to the next key zone around. So if I take this thing off this chart, I will expect the market to come back to this level in one way or the other. If it's not today, it will be tomorrow morning, right? So once you do this in the market, you possibly can create your structural analysis accordingly, and then you expect it to play out that way. Now, this is it. I will possibly just expect market to come like this. Sorry, let me remove what I wouldn't need. So I will just possibly expect this market to come like this and then drop into this market. This becomes our trade plan on this market as far as I'm concerned. The next key level that you have created in the market will often attract the market irrespective of where it is, as long as it is around the current market price. Some people have created a mindset that markets will react around some psychological level. Fine, if you believe in that, fine. But more than often, market has not done that accurately. So you just have to look at where the market has reacted and created some structure. So that structure is what you want to respect in future. Why the market did that structure is shouldn't be your business. Your business is for whatever reason that the market has created that structure, then it will be respected in future. Simple, and create a trading plan in line. So if one is validated, the next one will become a magnetic effect. Right? And that settles this point of view. Now, the next thing you want to do is, this is for AU. So we are expected to sell AU into this. So how do we sell this market? Now, this market is currently here. I want to be like, because the London market is often considered to be a period of consolidation. Market might continue to do like this, right? But tomorrow we should see a drop into this level, and that is around 0.7415 zone. Do you get? This is the basis and the precept of support and resistance, key level, and concept we call chart mapping. How to map your chart and identify the key levels and then create your trading plan. This is all, and this is where it begins and this is where it ends. Thank you. We're going to explore this more in the practical way and then trade it together in the intermediate group, and then also explore the loophole around this structure and how you can create your plan in case, also understanding your level of invalidation. Okay, so as we progress, that settles that. So let's go ahead and do. So since I have exhausted the pairs now, I will now go to trend line. So okay, let me put trend line on this chart. Now, if you want to put trend line on this chart, so this chart has these two structure, right? So this is a structure. This is equally another structure. Abe, this is equally another structure, but my work says respect the last two significant structure. So since this is a high, this is a higher high, and this is a higher high. Therefore, these structures are significant. So my trend line in this case is going to be connecting these two structures together. That settles it. So my entry into this market happens when this market violates this point at this point. So it came for a retest, and then the next thing is history. If you ask any trader to put trend line on this chart, somebody will tell you it's supposed to be this. Somebody will say no, it's supposed to be like this. Somebody will say, I know, my boss say, please disregard all these things. They are all not going to help. Pay attention to the principle upon which market operates by understanding the last two significant structure in the market. If the market is bullish, identify the last two demand in the market. What are demand? Areas where the market bought aggressively and create a new structure high, in this case, like this, in this case. You equally apply the same principle to any market in the entire world. So when you can see this, you have a higher high, right? So these are valid demand, then connect it. That is your trend line. Any other line you put on this chart is irrelevant. So immediately this chart got violated at this point, you knew the market will come to this level, right? So immediately this market violate, you knew the market will only come for a retest and then continue downward. Simple. Let's proceed. So invariably, we're looking at oscillators now. In the intermediate class, I'm going to talk about the main trend line and the induction trend line principle. Because sometimes when a market is coming up like this, is going down, right? There will be instances the market will equally be going up. This is what we call a pullback, right? Now, if this is a pullback, then this is equally a valid trend line connecting these two demand, right? This is a valid trend line, if I may say. And also, this is equally a valid trend line. So this is the main trend, right? And this is the pullback trend. So the main trend has what we call the main trend line, and then the pullback line has what we call the induction trend line. How to marry these two together and create a trade plan will equally be discussed in the intermediate class, and I will show you example in respect to this. Okay, now let's proceed and possibly come into oscillators. What are oscillators? Oscillators means momentum reading per indicator. This is the very first point where we're going to be applying indicator into our technical analysis. And the only indicator I make use of in line with oscillator is the RSI. Why? Because RSI is often very stable. RSI does not react to market manipulation as much as every other momentum indicator will react. RSI is bounded. You can look at RSI and tell the extreme at a glance, both to the upside and the downside. RSI, as what we call ratio analysis, you can look at the RSI and tell what the trend is, bullish or bearish, based on the face of movement of the RSI line. You can equally apply your pattern analysis using the RSI chart. Structure you cannot see on the chart will be obvious on the RSI. So the RSI is often a very handy tool that I always play along with. Now, this is it. What are oscillators in the very first point? Oscillators tells us the momentum in the market. Whether the market and the momentum is synchronized, is correlated, is moving the same way, or they are going different ways. More than often, if your market is going up, the oscillator should be following it and be rising. If your market is going down, the oscillator should be following it and be dropping. Whereas at a point, the market will be going up, the oscillator will be going down. This is what we call divergence. Divergence is the third law of the chart. We have three basic laws in chart: the law of supply and demand, the law of cause and effect, the law of effort versus results. What is effort? What is result? When the market is going up, that is the result of the push in the market. So the effort behind the push in the market is what you can monitor on the momentum. So when the market is showing sign of continuity in a particular direction, and the RSI or the momentum is not showing the same sign of continuity, that is what we call divergence. It simply means that there is no effort from the market maker in support of that move. You want to start looking for opportunity to avoid trap and then reverse in that market. But there are things to watch out for when you are looking at this kind of percept. So now, when you're dealing with RSI, this is how the RSI operates. From 100 to, so let's say this is 100, and then this is 0. That is the basis of which it operates. Then you identify the middle line, which is the 50 line, right? Please, you want to learn about all indicators in the market, please just PM me after this class. My user ID is CFANFS. I will send you a 1,350 pages book called Encyclopedia of Chart Pattern and Trading Indicator. You understand? But I can guarantee you will be true and you will not understand anything. So it is better you learn and master few things that works, that can guarantee your sustenance in this business, than to start jumping around and be learning multiple things, and at the end of the day you become analytical paralyzed. Analysis should not be more than what a 5-year-old baby should do in the forex market. If your analysis goes beyond that level, then it is becoming complex, and more than often when it becomes complex, you get confused. When you get confused, the result is obvious, and you don't want to get to that phase. Hence the reason why you are listening to me this night. Now, when a market, this is the RSI, we equally have what we call the resistance and then the support. Now, this is it. The very top here is called the extreme high. Then this is the extreme. Now, this extreme high is what we call oversold. Extreme low is what we call oversold. When the RSI penetrates into this level, we say the market is oversold, right? When the market penetrates into this level, we say the market is overbought. Overbought, oversold does not mean the market will sell. Kevin, bring this thing. So when you're looking at the market, obviously, you will see sign that the market, this is the extreme low. Now, this is it. The market is coming down. This is what we call our support. And then this is what we call our resistance. Everything is on the RSI structure. Then this is what we call the middle line. That is the middle line. Now, when you're looking at RSI, technically, for a bullish trend, market will often be above the 50 zone. But let's say, for instance, now, I will look at a bullish trend as a bullish trend is a one that operates, that swing between the extreme low and find resistance around the 65 zone. So this resistance zone is called 65 zone. This is 65. This is 35. And then this is 50. Right? Then this is 100 and this is whatever. So when a market is moving between, when you open the chart like this, and you can see the market moving between below 35 at the extreme low and finding resistance around this level, then you are in a bearish market. So your job is to be looking for opportunity to sell. So when you look at markets come like this, the next thing is that the market now started going up. You will prepare to sell the market as soon as the market hits the resistance level, yeah, isn't it? You sell. Whatever the market is, you find a sell around the 65 zone. Normally, RSI is created based on period. So I use period 14, RSI period 14, and I set it to close. So let's go to the chart and set this. But before we go, let me explain how to look at it. So when the market is bearish, a bearish market has a tendency for RSI to swing between the 0 and 65 resistance zone. A bullish market operates in the reverse. How? Going by in the reverse. Bullish market operate and find support, isn't it? So this is it. The bullish market will operate in this level and find support around this 35 zone and go up. So a bullish market will often reach the extreme high, and then when it's making pullback, the pullback will end around the 35 zone and then bounce up. So when the market is in a bullish trend, it does not penetrate into below the 35. When the market is in a bearish trend, it does not penetrate above 65. That is how the RSI guides you in the market. A lot of people have created different version of this RSI. Some people created what we call a TDI by bringing Bollinger Band into it and then applying some whatever. But the true basic principle of operation of the RSI still remain principal. Understanding this RSI is principal and more valid than looking at some other parameter that's really I don't want to give. Now, looking at the RSI from this point of view, you can definitely tell when the market is bullish. So when the market is operating between 0 and 65, that is what I would call bearish. Now, when the market is operating between the 100 and finding support around 65, we say the market is what? Is bullish. Because its market finding support is bullish and market finding resistance is bearish. Okay, now let's take a look at it on the chart. Now on this chart, you see that so let's put RSI on this chart, Control N. Then you come to this level and say oscillators. So you come to this level, you go to oscillators, you click on it, identify the RSI. So when you identify the RSI, put this one to color that you care about. So let's say I have this color, I want to put it this level. Then I will set this one, let's say this one is 10. This is how I set my own chart. So you can just look at it and set it. Put this one in, let's leave it anyway like that. It can be on close, but this is what I now eventually got. Now, this market obviously is bullish, right? Now take a look, bullish onto this level, right? So this is a bullish phase in this market, right? So you can see that the market moved from here, right? Of course, there's something that will come back to divergence. So the market got to this level, then made a turn back and come to this 35 zone and then penetrate up, come to this level, could not enter above this level again. Then the next thing, it fell down. Now that it fell down, it now came into the 35, the 10 zone at this point. So why it did this into the 20 zone, which is a bearish zone. The next thing that the market will do, come to this level and then sell back again. So you can anytime you want to sell the market, just look at where the RSI is realistic. The last level it dipped into was the 20 zone. And then if it dipped into the 20 zone, the next resistance should be around the 65 zone. Then your sell point should be around this level. When RSI comes to this level, just leave the market, come back tomorrow morning in the London, it should be operating around this level, this wherever. Then you can prepare to sell into this low wherever. Now, this is it. If you want to trade the Forex successfully, the lower the number of currency pair you analyze, the more profitable you will become. This is it. When you create your chart mapping, when you put your key levels on the chart like this, it is going to be practically difficult for you to manage looking at 10, 20 pairs. It's going to be practically difficult to manage 10, 20 pairs at the same time. Your job is to concentrate on this pair that you have analyzed and squeeze out all the meats. Stake into it. Meet your target on it. Then close the day, repeat the following day, continue where we stopped yesterday. That's Zato trade, not jumping around. And when they ask you at the end of the day, what did you have to show for this? Nothing. Do you get? Trading professionally cannot be that easier. So this is looking at the RSI from the whatever. So let's take a look at our notes, because it shouldn't be like okay, we talk about support, we talk about resistance, and we talk about trend line, we talk about relative strength index. So let's come to recent charts. Now, the RSI is being discussed in such a way that we have what we call ratio analysis, telling us where the different zones is based on what I have explained. Trend determination, you can look at it and talk about what is the trend at the current time. Then range shift in the sense that it looks for when the market shifts from bullish to bearish. So if a market is trading within the range of 0 to 65, that is a bearish market eating, resistance, and reversing, right? So, but if the market now penetrates beyond 65 and enter into the 80, 90 zone, then it means that the market has shifted from bearish to bullish. So the very first time the market penetrates above 65 zone, it means that the market has shifted from bearish to bullish. So also, the very first time the market penetrates below the 35 zone, it means that the market has shifted from bullish to bearish. This is just how the market operates. I'm going to be doing practical example on this in the intermediate class, and then you will enjoy this topic the more. But one thing I want to emphasize today is the importance of divergence using the RSI. Divergence itself is a broad topic, but within the concept, within the parameter of this training, basic, I just want to understand you to understand something, that there will never be a turn in the market without a divergence. But technically, all divergence will not lead to a turn. So when you see a divergence occurring in the market, it is a sign that you need to analyze your chart and review it, whether you should be looking for a reversal. But whenever you see a market showing divergence, please don't initiate too much commitment in the current direction, because the chance that it will reverse against you is high. So divergence in the market is like a guide as to letting you know when to add to your position or when to hold your bullets. So for instance, what is a divergence in the first place? We have two types of divergence, called the classic divergence, and then we have what we call the hidden divergence. So the form of divergence, we say we have the classic divergence, which is called the reversal divergence, and we have the hidden divergence, which is called the continuation reversal. Now, for instance, let's say the market is going down like this, right? RSI definitely should be going down, right? But a time will come, the RSI will not be able to do a new low. So you now have the market creating a lower low, but the RSI is finding it difficult to create its own new low. This is what we call divergence. Since this market is currently going down, let's say this is what we have, we apply our trend line like this, right? Since we cannot apply the same trend line on the RSI, immediately the candles market close above this trend line, then it means that the trend is over. We want to be reversing this market to the upside. But what gives us the clue that this market is very much likely to reverse is because the market is showing sign of divergence on the lower scale. So divergence can occur at any place in the market, but there are particular levels in the market where divergence occur and it's considered to be a very vital level to respect. I hope you can flow with this graduation in this class. If you can't, please don't hesitate to engage any of the admin in the group. And I'm sure nobody will leave you stranded. So when you join the intermediate class, a community will be created for you where we will do what we call thorough mentorship, thorough trade planning. Then meanwhile, while you are learning, you equally can copy MJ Trade on the IS Social. It is free of charge. Everything is free of charge. We just want you to be happy. Now, when the market hits this level, we come to reverse. So let's go to the chart and track these structures as we said it. Now, just as we talked about the direction to the downside, so also when the market is going up, right, a new high has been formed. But RSI, instead of doing the up, the RSI could not do it. The market is now finding it difficult to do a new low. In this case, this is what we call classic bearish divergence because the market is prepared to go down. So what do? You apply your moment trend line, and then when the market closes above the moment trend line, more than often it will be like this. Something like this. This is what you're going to be having. Why does it have to be steep that way? Because the movement in this trend from here should be reduced as a sign of no interest. The movement from year to year must be higher than the movement from year to year. So this level is, this length is shorter than this length. So this is a sign of weakness that the market is no longer interested in going up. And that is what divergence simply indicates. So it will be steep. So the time the market will close below the moment trend line will be short. So you don't need to waste more time. So perhaps the market now give a candlestick below this, wherever you take your sell. So also, if the market is coming down, you apply that, you have a divergence like this. Market cannot make a new low. RSI cannot make a new low. Whatever has done this. So you apply your moment trend line like this. So when you apply your moment trend line, collecting this order, you made the candlestick close above this trend line, you reverse the market. So the guiding principle as to whether the divergence will be respected or not is the validation of the trend line that is trading the market. So if you don't know how to draw trend line effectively, you will be wasting PIP trading trend divergence, or you possibly will become a victim of false divergence in the market. I don't want to go beyond this level this night, so that so that we can assimilate this first, then we can add up to it. So I'm going to stop here and then continue with this divergence principle, because it's a broad course on its own that you need to have a perfect understanding in our next tomorrow class. Mind you, tomorrow is not a training. We have training next tomorrow. That will be on the Friday, right? Today is Tuesday. So am I correct? Sorry. Today is Tuesday. So tomorrow will be Wednesday. Yes. So if tomorrow is Wednesday, I should have a class tomorrow. So if I'm having a class with you tomorrow by 9:30, so you join me tomorrow, and Friday we end this whole thing. We do the second to the last class tomorrow. Then we do the last class, which has to do with psychology of trading on Friday. Okay, I'm sure that helps. But meanwhile, do not waste this opportunity to make active discussion in the group when there is no training. So thank you very much, everybody. So I will continue this training on the divergence principle. I don't want to rush it so that it doesn't become like it's not thorough and it's not in-depth. We are not going to be hiding anything. Everything is going to be presented as it is, but we can assure you that if you pay attention and you put your self-factor, success is guaranteed. Thank you very much. MJ Young, I'm going to be giving you the mic this time around, then you possibly just help me to anchor the remaining part of this session, then we can now proceed and call it a day. Thank you very much, everybody. It is my joy, my respect for you to have given this sacrifice to be here till this moment. Thank you. I have my respect for you. Thanks. MJ.
Oh, thank you so much, Mr. Tijani.
Yep.
Thank you so much. What a wonderful teaching and a wonderful class. Let me tell you what you are having so far. I must tell you that it values not less than 1,500 US dollars. And then I am telling you, you are getting it for free. But I want to take this last section of like 10 minutes to 5 to 10 minutes to address you. I will always in each class start it and end it from now henceforth. And don't worry, we are still coming up. I really, really appreciate you guys. You are trying your best. First of all, I want to do something for you. Mr. Tijani,
Sir.
can you help me to share my screen? Please allow me so that I can share my screen quickly before I round up.
Okay. Okay. I'll make you the admin again. So.
Okay. Thank you so much. Thank you so much. Guys, thank you for your patience. Thank you for your patience. By the way, please, Mr. Raymond Cassie, our head in Edo State, please, Mr. Raymond, please try and create a group for these people. Please help us and create a group for them so that I'm talking about the participants. We want to, let's be able to isolate the people that are participating in this training from the general crowd. I know we had 90 something the other day. Today we are having 40, 42, and 40 something. I know there are other people that are going to be watching the video. So we want to make sure nobody is coming to ask us questions who is not participating. So except the person is watching the video or watch the video. So please, Kasieri, take note of that. Okay, guys, I believe you can see my screen. You can make comments if you are seeing my screen. I'm going to conclude on this. This is a food for thought. Because while Mr. Tijani was teaching, I know most of you guys would have been like, oh, come on. This thing is difficult. Trend line, this supply, demand, what is happening? I didn't read economics in school. What is bringing supply and demand? Let me tell you something. This is originally what supply and demand should be for us. I'm telling you the facts, and we are seeing how to make this supply and demand real money that we were taught in school, maybe in secondary school, maybe in the university and the rest. So I want to bring something to your notice very well. This is my favorite picture in the Forex industry. Please take note of this picture. I want every one of you that is here, post it on your WhatsApp status. Make sure you post it every day. Make sure this picture is there. Look at it, not for somebody else, but for you. You have started a journey. The first law of success is for you to follow a proven mentor. It's not for you to learn. The first law of success is not learning. The first law of success is not trying. The first law of success is following a proven, your ability to identify a proven mentor and then follow that proven mentor. That's the first law of success. So it will be a waste of time if you are trying to achieve something in life without first of all identifying people that have gone there. Let me tell you something. A mentor is not your friend. It's important you know this. A mentor is not truly your friend. You might have known somebody for years and he has been your friend, maybe your brother, and what. The moment you identify that person as a proven person in any field or field of knowledge, that person that they cease to be your friend is now an authority and a mentor. If you relate with him based on that, on the strength of that, you are going to be successful. Why am I bringing this to you is because there are a lot of us that are here right now. This whole knowledge is like complex for us. And you are like, oh, come on, this thing, they are rushing it. Oh, I don't understand. I'm getting lost. Trust me, every successful man was once lost. That is why there is something called direction. No man, if you don't get lost, you won't need direction in life. Direction is the need for direction is the proof that a man took a step and along the way he missed it. And so therefore, he is asking questions. And that is why we are here. The group is there, the admin is there. If you fail to ask questions, then you are not entitled to answers. So I am saying this, that you have found sets of people that are proven. Number one, Forex is a journey. Forex is not a dating. So you need to calm down and follow what you have been told. Go back. We are going to be posting before 8 in the morning. You are going to be having the YouTube, this very day 3 on YouTube. Go back and watch it again. If it take you to watch it 3 times with your laptop, we will do it. And don't worry, I am coming up for section. I will be coming up for beta section, full section, Mr. Narish in India and Mr. Ever again. There are important things we'll be addressing. But take a look at this. This is the Forex journey. For me, it has been a journey all through for about 11 years now, even as a very young boy. The first stage in the Forex journey is that we say first, you might be broke and helpless. Can you look at your screen? You look at the guy sitting down with his laptop, with a torn clothes and looking, very tattered, unkempt, and the rest. Trust me, I'm not saying everybody will go through this. Somehow your mind will go through it. Somehow there will be time like you are hopeless. You are going to be, now I know you are receiving hope, but when you go on, you begin to like, oh, come on, this thing is different. I don't understand. I'm losing money. I'm not getting it. You have to be patient with yourself. Don't be too hard. That is the first stage. Every trader goes through it. Accept it. Number 2, the second stage is if you persist enough, you are going to rise and you'll be given a chair. From sitting on the floor, your clothes may not change too much, but at least a singlet will be put on you from a rag, then you are given a chair. This is the point where we say you will see the vision and become focused. At this point, maybe you have lost 3, 4, 5, 10 accounts, and suddenly you made money in one. Maybe you deposited $200, turned it to $500 before you lost it, and then you're like, wow, I think there is a gold mine in this thing. And you are the second stage and you are seeing it clearly, like, come on, this Forex thing is very serious. And then the next is you put more effort, you put more focus, you put more energy. And the third stage is your result is going to explode. And when your result begin to explode little by little, you will set higher goals. I'm telling you the truth. I know there are a lot of you now that if we talk about earning 100,000 in a month, 200,000 in a month, is like a big work in your mind is very big. But trust me, it's not as big as you think. The moment you start making money, I know some of you are saying, if I can make 100,000 naira, I'm okay. You are not okay. You won't be okay. The moment you get to the third stage, you are definitely going to set higher goals. And the last stage is financially free, where everyone will want to be your friend. On Saturday, I will be speaking to us about the School of Money. I'll be introducing us to the School of Money. I'll be talking to us a lot about the Forex industry, how to succeed, how to truly pick yourself from the start, how to manage the process. You get to know how to manage this whole thing so that you shorten your journey within the next 3 to 6 months and you are successful. Ladies and gentlemen, I am telling you, this is something very, very important for all of us. And I want to conclude with this today because you are a trader, so you should be seeing what I am seeing. If you are a trader, you should be seeing what we are seeing. Let me do this. Okay, this was for yesterday. Let me share a photo of trading for you before we go. Okay, I believe you can see my screen for today trading. Today is the 13th and the 13th of July. We traded GBP Austria, even with a higher tech, and you could see the profit 651. And I'm showing you this screen not to wow you, not to make you feel okay, MJ is an hero or the team or anybody. No. I'm trying to say that few years ago it was not so, but I embraced the process. Today, it is normal for me to make profits. I've lost accounts again and again, countless of time in the process. It is part of it. So ladies and gentlemen, nobody will pamper you on this journey. If you cannot give yourself even 3 hours or 2 hours to 3 hours a day for you to learn this, you are not serious. If you embrace this Forex thing as an alternative, let's come and see if it will work. It will never work. But when you put your mind to it and put your energy and said, no, I think I want to be in this, you'll be having this kind of results. I'll conclude by sharing with you something that I had as an experience. In fact, we were actually learning from Apostle Joshua Selman. He was taking us through a Forex class in 2010 for good 2 weeks, 9 in the morning to 4 in the evening. Apostle Selman, take that class, a training class with us. And the first day we started the class, something amazing happened. And I know you will laugh, so I want to conclude with it. The moment, we started the class and, he placed a buy and close, place a buy, a sell and close and stuff like that. The next thing was that he asked if there was a question after the class, and a guy raised up his hand and they asked him, okay, what's your question? He said, please show us where to withdraw. Just show me where to withdraw. I want to withdraw. Show me where to withdraw. And they're like, this is your first day. This is a 2 weeks training. And we all started laughing. The guy said, no, I'm serious. Show me where to withdraw. We started laughing. Imagine you came to the university the first day and you want to know how to be a graduate. You want to be given a gown, it's sort of a matric gown. You want to be given a gown showing that, oh, come on, you are done. No. Ladies and gentlemen, what am I saying? You are definitely not going to know how to just withdraw in the first day. Be patient with yourself. Some of you right now are saying, just show me this, show me that, show me that. Calm down. Your questions will be answered at the course of the journey. It will not be clear at the start. The more you go, the more you put your energy, the more your questions will be answered. So I want to welcome you to this section of training, and I want to emphasize lastly in the next 30 seconds, the link for opening account with our broker Infinos is already on the group. They have posted it on the group. Click it. The person who posted it is Mr. Raymond Cassie. And if you have any question at opening the account, chat him, take his number down and chat him up. He is going to answer you. So we want to make sure that you don't get left behind. And we are finishing the beginners class on Friday, not completely anyway, because Saturday we'll be having class, Sunday we'll be having class. So on Sunday we'll be finishing it because I'll be coming in, others are going to be coming in. Then we're going to be starting the intermediate class. So it is important you rush to fund your account. Open it now and fund it. We may not give more than 2-3 days after just for you to make sure you do that. So do it early. Ladies and gentlemen, lastly, make it a duty to post what you have learned on your status. I want to see it. I want to make sure you are following. Don't be selfish. Post the handle also. This is not for popularity. Trust me, I don't have a money problem. Trust me, I don't mean insult. I don't have a money problem. So, but how do we reach out to you? Somebody posted it, you saw it, and you are here. What will it take you out of love to post it on your status and tell somebody, please advise you be in this? Do you know a few years ago, it was a lady that told me to attend a seminar like this. I was not aware. The lady told me, she came with the news. It was quite unfortunate that the same girl did not attend the seminar she brought the information about. 10 years later, the same girl is struggling to now start to learn Forex and she can't find her way. But the class that laid the foundation, she brought the information. I will conclude with this. Do not let your life be a signboard that directs people to a destination and you are not going there. Don't become a signboard who directs people and you are not going there. Thank you so much, ladies and gentlemen. Please, I want to see your status. Be committed the moment we finish. Thank you and God bless you. Bye.